Well, good afternoon, everyone. Cynthia Tomaine with Interactive Brokers, and thank you for joining us for today's webinar, where we'll be covering crisis correlation, the hidden risk of diversification. Now, before we do get underway, I would like to bring on my colleague, Mike Kruger, who will give you a brief introduction about Interactive Brokers as well. So, Mike, what I'm going to do is pass the controls over to you, and if you can go ahead and share your screen, we'll get started here today. Thanks, Mike, and thanks all for joining us.
Thank you very much, Cynthia. I appreciate that. Can everyone see my screen at this point?
Not yet. There should be a window that where you can.
See that.
There you have it. Now we're ready.
Okay, perfect. So good day, everyone. Thank you, Cynthia. And before introducing Rob, I wanted to present some background on IBKR for those in the group who may be unfamiliar with the firm. Interactive Brokers has over 450,000 accounts with 24% year-over-year growth, accounting for $115.7 billion in client equity. That represents an increase of 40% over the same period. Our client base accounts for 696,000 daily average revenue trades. Based on those figures, Interactive Brokers is the largest U.S. electronic broker-dealer measured by daily average revenue trades and the fastest growing publicly traded U.S. electronic broker measured by client accounts, equity, and DARTs. Interactive Brokers Group LLC is publicly owned and management maintains a significant stake in the business. IBKR operates conservatively without leverage and does not participate in the over-the-counter market, removing any counterparty risk exposure. We utilize automation wherever possible, including management of all payable and receivable activity and margin compliance activities. Interactive Brokers is a self-clearing entity with a diversified client base. These graphs break out sources for IBKR's accounts, client equity, and commission revenue. The firm draws its client base from individual investors, financial advisors, proprietary traders, hedge and mutual funds, as well as other broker-dealers. Interactive Brokers supports global trading access and accepts clients from most countries. Our universal account structure makes trading stocks, options, forex, bonds, mutual funds, and ETFs a seamless activity, allowing clients to manage all asset classes from a single account. We offer clients exceptional trading technology and are committed to providing best execution. This keeps costs in check for everyone, leading to superior return potential. Beyond managing your investments, Interactive Brokers allows clients full financial management options. Interactive Brokers customers can borrow against their assets at our low margin rates, earn interest on cash credit balances, spend against cash or margin buying power with our new Interactive Brokers Debit MasterCard, and invest globally at an all-in lower cost. Interactive Brokers provides the investors marketplace where investors, investment managers, and service providers can advertise and find resources to expand or improve their businesses. Here you can find programmers, analysts, money managers, and technology partners like today's webinar partner, InvestiQuant. Interactive Brokers also provides mobile product solutions to help our customers maintain access to their Interactive Brokers accounts on the go. For any additional Interactive Brokers questions or for further information on our products and services, please feel free to contact me at these details. I'm now pleased to introduce Rob Hanna, co-founder and vice president of research at InvestiQuant. Rob has been a full-time market professional since 2001 as president of Hanna Capital Management, LLC. He first began publishing his market views and research in 2003. His twice-weekly column was featured on the Trading Markets website. Rob has started two websites himself, Quantifiable Edges and Overnight Edges. Both sites use historical analysis to assess current market action and odds. Rob utilizes price action, volume, breadth, sentiment, seasonality, liquidity flows, and more to conduct his research. His work has been widely referenced and quoted over the years and is often linked to in blogs, magazine articles, and other media. In 2014, Overnight Edges merged with Master the Gap to become InvestiQuant. Rob, please proceed.
Thanks, Michael. Hi, all. I hope you can hear me. Can my screen be seen right now? Someone could click a yes or?
We're seeing it. We see your title page, Rob, so we're good.
Excellent. All right. Well, thanks for coming, everybody. I'm Rob Hanna of InvestiQuant, and today we're going to talk about correlation risks during times of crisis. And I'm going to use the 2008 market crash and bear market as an example. With the market at all-time highs and volatility at all-time lows, discussion of market crash behavior might seem like an odd choice here. For fans of the Netflix show Stranger Things, the 2008 market might seem like the upside down to today's low volatility bull. But I found the best time to prepare for something is when you're far removed from it. So understanding panicked behavior and how not to get swept away by it is easiest when there's emotional detachment. New highs in a low volatility environment have most people about as emotionally detached from the 2008 crisis as you can get right now. Market crashes and other high volatility environments hurt so many people because they're not prepared for them. So stress will often lead to poor decision making. And when volatility is high and decisions need to be made quickly, there's not much time to analyze and study. So you get rushed analysis, fast-moving prices, stressful decision-making. We got a 24-hour news cycle now. Lots of money on the line can all quickly lead to panic, and panic on the part of the public, panic for the market, panic for traders and investors that aren't prepared. So today we're going to do a study of one such panic in the hopes that we'll all be better prepared than most when the next such crisis occurs. It's important to keep in mind the concepts I discuss aren't just applicable to 2008. It shows behavior that was evident in 2001, 1987, and other crashes. Even the 2010 flash crash, which was over almost as soon as it started, showed similar behavior. So with all that in mind, let's peer into the upside down. Anyone that's traded more than a day or so understands that there's risk in trading. And even if you haven't traded before, you should understand this. So I just want to give you a chance to look at this briefly. And some of the information I'm going to be sharing in the presentation today is based on hypotheticals. It's market research. And I've learned an awful lot about the market doing research. So I found it back testing and research to be an invaluable tool for my own trading. But it doesn't mean that everything's going to work exactly the same in the future, and you need to keep that in mind, and there is risks in trading. All right, let's talk about what we're going to talk about today. First, we're going to discuss equity curves, because really that's what we all care about. We'll talk about the ideal curve and then the individual bumps along the way. We'll talk about one method of smoothing those bumps, which is diversification. And I'll discuss where typical kinds of diversification help and where they don't. I'll introduce a topic we'd InvestiQuant refer to as crisis correlation risk. And this will lead us into methods of coping with and hopefully flourishing during times of market stress. After that, I plan to pass the mic to InvestiQuant CEO Scott Andrews. Scott's going to take a few brief minutes to introduce IQ and some of our solutions. And then lastly, we'll do some Q&A. As we go through the presentation, I'd encourage anyone with questions pertaining to the current slide or topic being discussed to go ahead and ask. I need to know if there's something I'm not explaining properly. But for more general questions, I'd ask that you hold them for the Q&A session at the end of the presentation. At that point, you'll be able to direct your questions directly to me, Scott, or any of the people at Interactive Brokers or Garwood Securities that are on the call today. So sit back, relax. Hopefully we'll be able to take something away from the webinar that will help you earn more over your investments over time. All right, I'm not going to spend too much time on myself, but I thought it'd be helpful for those of you that are not already familiar with me to at least have some understanding of my background. Michael mentioned a lot of what I've done in the past already, so I'll keep this fairly short. I've been trading for about almost 20 years now. In 2001, I began trading professionally, and I established Hanna Capital Management, which basically managed a friends and family style limited partnership, and I still manage that today. 2004, I note here as an important date for myself because it was at that point that I first really began doing quantitative research. 2004 was the first real difficult year for me. The first few years that I was running Hanna Capital were great, and then in 2004, the strategies I was using struggled a bit. A lot of what I was doing at that time was breakout trading and trend following, and 2004 was a very rotational market, so oil stocks would all of a sudden break out, and I'd jump into a bunch of them, and then the market would rotate, and they'd come back to earth, and tech would go, and then they'd come back, and retail or finance or whatever it was. So there's a lot of rotation within the market, and that became a very difficult environment for me to trade. So I began doing quantitative research, because what I saw was a hole in my own trading, and I realized as a one-trick pony I wasn't terribly diversified, and I needed alternate strategies that would do well during times when the strategy I was employing at the time wasn't in favor. So that's when I began doing studies of market tops and bottoms and turning points in the market, and that was a long project, and it really got me excited about learning more about the market. And one thing led to another. I've been researching the market and learning ever since. I've written, as was mentioned, for a bunch of websites over the years, and in 2014 I started heading up the research group here at InvestiQuant, as Overnight Edges and Master the Gap came together to become InvestiQuant. And we'll tell you a little bit more about InvestiQuant later on. Scott Andrews will jump in on the call, and he's our CEO, and I'll invite him to tell you a little bit more about our group. But let's get to the good stuff. Enough about me. All right, so this is what we all strive for. The perfect equity curve that goes from lower left to upper right without any dips along the way. All right? Every trade's a winner, every day's your birthday, every night's a party, and you're not responsible for cleaning up after. Unfortunately, life is not like that. I've never met a trader that did not have losing trades, and I've heard that even Kardashians have bad days. I've yet to see a long-term equity curve without a single dip in it. When we measure these dips, we refer to them as drawdowns. So a drawdown is defined as a peak to trough decline during a specific recorded period of an investment, a fund or a commodity. Drawdowns are usually quoted as the percentage loss between the peak and the subsequent trough. Let's take a look at an example of drawdown on a chart. That's the easiest way to really understand it, is by visualizing, at least for me. So what we see here is that from point B to C, we have one drawdown, and on this chart, that's actually the maximum drawdown. That's the largest pullback we see during the time. From point D, there's also another pullback, and there's drawdown there. It's not as large as the B to C drawdown. So max drawdown is often a metric that's examined when people are looking to measure risk in a portfolio. And the max drawdown is the maximum loss from a peak to a trough of the portfolio before eventually a new peak is reached. Hopefully, right? And it's shown here between B and C. The important point here is that minor drawdowns can be recovered fairly easily, but when you get a major drawdown, a major hit to the portfolio, it can be very difficult to recover from. So let's look at some of the math that explains how hard it can be to recover from different sized drawdowns. All right, as you can see here, smaller drawdowns don't take a whole lot to recover from. The deeper the drawdown, the more the math is going to work against you. 10% drawdown would take a $100 account down to $90, and then to get back to 100, it only takes an 11% return. But if you lose half your account value with a 50% drawdown, you then need to double your account with a 100% return just to get back to the previous level. So this sort of math can help you define your uncle point. And further, can help to better understand how long it can take to recover from that point. For example, let's say you're willing to risk 25% of your account's value on a strategy, and that strategy historically has produced 10% annual returns. So from this chart, you can see it would take more than 3 years of anticipated positive performance to recover from a 25% drawdown to new equity highs, because you're going to have to go up 33% from that low. So one common method for containing drawdown is to employ diversification. Rather than putting all their eggs in one basket, investors will spread their investments among different asset classes. And let's discuss positives and negatives of that. First, let's look at diversification and how that would have helped over the last several years. So now now that we've fully grasped the concept of drawdown, and I'm sure most of you already did, so thanks for patience. This chart is a nice example of how diversification could help to control that drawdown. The table above is showing quite a few numbers, but they're very, very important in the way they all come together. So I'm going to discuss it in detail. Feel free to question me if I'm not clear on anything. What we're looking at here is 6 distinct asset classes. And I'm using the ETFs of each to measure their performance over time. So we're looking at investment-grade bonds, gold, the S&P 500, junk bonds, emerging market stocks, and real estate. And this is a year-by-year look at the max drawdown for each of these ETFs from its peak to its valley during that specific year. So it's just during that year. In other words, the 17.8% drawdown in gold in 2016 all occurred within that calendar year. Carryover from 2015 wasn't measured. So you'll note that we're just looking at drawdowns here, not total returns, because I'm focusing on the risk side of the equation for this discussion. Of course, the more volatile security classes typically show larger drawdowns. So in this case, while emerging markets and gold have performed much differently on a total return basis over time, because they're both volatile, they both show some of the largest drawdowns during those individual years, right? What's suggesting that the concept of diversification is working over this time period is the max drawdown column here at the bottom. Now, I should note that this is a hypothetical portfolio, and it assumes yearly rebalancing. But if we look at 2015, for example, you see here that everything except for investment-grade bonds had a drawdown of greater than 12% during the year. Yet the max portfolio drawdown is actually less than 12%. You're not just averaging these drawdowns together. What's important to understand is that there's low correlation among these asset classes during normal market environments. All right, so these drawdowns occurred at different times, and because of that, diversification worked well. We can also look at, say, 2013. So here we see, even with a 30% drawdown in gold and 19% in emerging markets and real estate, the diversified portfolio saw a drawdown of less than 10%. Now, that's the apparent beauty of diversification. And these are the kinds of stats that someone will show you who's trying to sell the concept to you. And it has worked well during these normal market environments in the last several years. But it does not always work so well. And it especially does not work well in crisis environments, because correlations tend to rise. So let's, well, before I get into that, let me show you a chart of the last 2 bear markets and the bulls that preceded them. So this shows the 2001 to 2003 and then the 2007 and 8 bear markets here. And we see that both of them occurred following multi-year bull runs. Best time to prepare for a major correction is before it starts, not when it's already well underway and your portfolio has suffered a big drop. So I point this out because we're currently in a long-term bull. And it certainly appears to be a good time to calmly examine things, like I mentioned earlier. So let's take a closer look at the correction in 2008. And I'm going to start by showing a chart of when the correction was at its worst. So we saw some of the strongest moves during this time period, which was October and most of November in 2008. So this chart goes from September 30th to November 24th of 2008. And it's a percent change chart. So it's showing how much in percent change each of these asset classes changed. These are the same asset classes that I just showed in as a diversified portfolio over the last several years. What's amazing here is that even AGG, which seems to hardly move for most of the time, saw a 10% drop early on. So when things started to fall apart, even that saw a 10% pullback. Of course, IYR here was the worst, and that had a decline of nearly 60% at its worst from September to mid to late November here. And this is what we call crisis correlation risk. This demonstrates it, where all of these markets are moving down at the same time. There is no benefit to diversification when everything falls apart. And when you get into a crisis environment, when there's selling everywhere, all of these asset classes tend to get highly correlated, and they all fall apart, and it becomes a scary panic type environment, right? A crash environment. All right, so let's now look at 2008 in a similar way to how we looked at the drawdowns over the last several years. This is the same list of securities we just saw, and the same assumptions for a hypothetical portfolio, but now we're looking at drawdowns in 2008 instead of over the last few years. And there's some hefty numbers here. And it was because the drawdowns all happened in concert, like we saw on that last slide, that the portfolio drawdown really wasn't spared. Even being spread apart, even being diversified among all these asset classes, the hypothetical portfolio would have suffered a drawdown of 40% during 2008. That's a hefty return or a hefty drawdown to try and recover from. So diversification fails during these times, and that is a big concern, and you've got some serious damage to overcome if the strategy is long everything but diversified. Not only did everything happen that year, or not only did we see a large pullback, a large drawdown that year, but what's also interesting, another way to view this, is by looking at the dates of these major market bottoms. We can see that all of these different markets had major bottoms, all within the similar time frame. All right, all 6 markets experienced this major bottom within a 5-month period. So from the investment grade bonds that bottomed in October of 2008, emerging markets bottomed in November, along with gold also bottomed in November, and then real estate, the S&P 500, and junk bonds bottomed in March of 2009. But if everything's bottoming at the same time, that means that everything has had some major sell-offs leading into those major market bottoms. All right, so diversification is failing under instances like that. Let's discuss why a little bit. In normal market environments, people buy the most appealing assets, and they sell the least appealing ones, right? So there tends to be rotation in the markets. I talked about the rotation that happened in 2004 that led me into doing quant research. But some asset classes will do well, other asset classes won't, and there'll be rotation. But overall productivity and expansion of global wealth allows simple, long-only diversification to work under these circumstances. So underperforming assets are cushioned by the best performers, and the portfolio will rise overall. When we get into a market crisis, it's no longer a rotation of wealth that is seen. It's a destruction of wealth. And you get heavy losses during these crises because you have forced selling. Wealth is gone once drawdowns get steep enough. There's margin calls. There's mortgage default. There was an awful lot of them in 2008. And the value of all of the securities that are backing those mortgages disappears. So people need to sell whatever they can to remain solvent. And because whatever they own is being sold, this basically causes all asset classes to lose value. Right? That's what I mean by rotation versus destruction. Everything is getting killed in these crisis environments, in these really bad bear markets. So the chart here is from a report that was recently published by Societe Generale. It's not data that we compiled ourselves at InvestiQuant. The table compares managed futures, hedge funds, equities, and fixed income. And what stood out in this report, and on this chart here especially, was that managed futures as a group both saw reasonable drawdown, a little under 12%, and this is key, a different bottom date than everything else. Not just in this chart, but the one I showed earlier, we see that everything else is bottoming in that late 2008, early 2009 time period, right? Here, managed futures are bottoming in September 2013. Now, it's worth noting that managed futures and hedge funds are not really asset classes in the same way that stocks and bonds are, but many large players treat them as such, and that's what SocGen did in this table. So how is it possible that managed futures didn't bottom at the same time as everything else? As a group, they trade in the same asset classes that we saw all struggle during this period. The answer lies not with the asset class, but with the strategies employed. Of course, managed futures is a broad characterization, and no single strategy will mimic this index. But I believe that that's exactly why we see it appear uncorrelated. It's not that they're necessarily trading different assets, it's that they're trading them in a different way. And this is something we call strategy diversification. All right, and I'll discuss strategy diversification a little bit further in a minute. But the important takeaway here is that the magnitude and the timing of the managed futures drawdowns was completely different. Right? And that was achievable not by trading different assets or owning different assets, but trading them in a different way. Okay. All right, let's think about those charts from 2008 for a moment. They weren't smooth, and of course, not everybody was long. Anybody see the movie or read the book, The Big Short? You know, my point is that high volatility and steep selling isn't necessarily a bad thing. You know, when life gives you lemons, make lemonade, right? So what happens is we have plenty of opportunity that arises during these times of crisis as well, or as market environments are changing. When you get higher volatility, that increases both potential risk and potential reward, right? Crisis environments, the second bullet point here is very important. Crisis environments typically see sharp swings in both directions. It's not just that everything tanks and goes straight down. You get sharp moves both ways. Reactions during these stressful times are often overreactions is what ends up happening. And when you get overreaction in one direction, that often and quickly lead to an overreaction in the other direction. So you can take profits more quickly if you have them, and the gains could be just as sizable. And I'll show that in a minute. It could be even more sizable, taking quick gains in a highly volatile environment versus holding a long-term position in a low volatility one. So shorter trading time frames can really help limit the risk because you're not staying in for an extended period, but you can still maintain high potential for reward because those gains and losses can be achieved much more quickly, right? If that's what you're going for. So this chart is of the exact same time period that we saw earlier. When we looked at the percent declines of the 6 different securities, this goes from the end of September to middle to end of November in 2008. And it's a candle chart of SPY that also allows us to see the intraday ranges. It's remarkable just how large the ranges are and how choppy the move lower is. Remember I talked about overreactions in both directions? Well, I mean, this exemplifies it in spades. You're seeing sharp move down, huge move back up, big move down, up, down, all over the place here in this chart. You rarely get the market moving in the same direction for more than a few days. And I looked at the average intraday range of the bars for this period, and I found that it was 6.4% of the index price. This is intraday, from 9:30 a.m. to 4 p.m. Eastern Time. To put that into context, the average monthly range through the first 11 months of this year, 2017, has been just over 3%. So there was more than 2 times the opportunity to profit in one day during this time period than there was an entire month in 2017. And that does not even include the overnight period. If we look at absolute changes from the close to the next day's open, the average gap was about 0.8%. That's over a 20-point gap in today's terms, on average, every night for nearly 2 months. And this doesn't even consider the range that the futures moved during the night. What it does show, what all this shows, is that there was a lot of opportunity in very short time frames. Okay. So we know when we get into crisis opportunities, there's plenty of opportunity. And we know that long everything's unlikely to provide us adequate diversification. But strategy diversification, like we saw with managed futures, can potentially help to reduce risk, reduce portfolio drawdowns, hopefully protect wealth. And here's some just examples of strategy diversification versus long only, right? Just buy and hold or hold across a set of asset classes. There's market neutral strategies. There's trend following type strategies, mean reversion strategies, short-term strategies, which look to take advantage of moves between 1 and 3 or 4 or 5 days that are often called swing trading strategies. That's something I've done a lot of myself. A lot of research, a lot of trading. I've designed systems, and we have programs related to that. The overnight, I mentioned there was huge gaps in the overnight, and I've done quite a bit of research there, and trading with the overnight. And intraday. Intraday is something that Scott Andrews, who I'll introduce in a minute, has done lots of research, lots of trading, lots of system development related to intraday type trading. So what you want to do is just make sure that you've got a few different kinds of strategies that could help you diversify. You don't want to be the one-trick pony that when things aren't going your way, all of a sudden, if your strategy is falling out of favor with the market, especially if it's a long only, and say, well, I'm diversified. Well, things are starting to fall apart, and you need to be able to tighten your time frames. You need to be able to do all these different things, and it's nice to have that already in your back pocket. Strategy diversification. Let's go back. I want to show you this chart again. Remember that slide I showed? It looked at the last two major market corrections. Now, anyone that's been following the market over the last few years knows we've been going up and up and up. So this is a similar chart looking back to the 2009 lows. All right, and the point here is that we have been going up for quite a while. In fact, we're in such a persistent uptrend lately that we haven't had a 3% drawdown since since early 2016. I think it was January or early February 2016. So this is the longest such period ever that the S&P has gone without so much as a 3% pullback. And being sure your portfolio is properly diversified is important. When I discuss diversification, of course, I'm talking about strategy diversification. Give yourself a chance to be in a strategy that's in line with current market conditions, no matter what those conditions are. And that's as important, and I believe more important, or at least equally as important, if not more important, than diversifying across asset classes. So, with all that said, I want to invite Scott Andrews for a minute to talk about our company. He's the co-founder of InvestiQuant. He's our CEO, and he's going to introduce InvestiQuant to you and talk a little bit about our stuff. So, Scott, the mic's yours, assuming you're there.
I am. Thank you, Rob. Can you hear me okay?
I can.
Great. So what Rob has just described, and I think you've done an excellent job, is something that many of you probably know as modern portfolio theory, concept written about by a gentleman named Markowitz a long time ago, but it still holds true today in our opinion, and many of our clients as well. The idea is basically through diversification, like Rob has talked about, you can maximize your risk-adjusted returns, and it's a great technique. The key is to have diversification of lowly correlated assets, or as Rob pointed out, strategies. And that's essentially what our whole company is about. So we provide an alternative way of diversifying your strategies, maybe a little bit more unique than many of you are used to right now. We started the company, actually started in 2008, a company called Master the Gap. I was trading the opening gap. I had a trading room, and I called out my signals, my actual trades, live trades in advance during the financial crisis, and developed a pretty big following. It was an awesome time to be a trader. As Rob pointed out, the volatility was off the chart. And when you trade strategies like we do, which can go long or short, over very short time frames and volatility is high, it can be a fantastic environment. 2014, Rob and I joined forces, and we raised several $1 million to basically fund the growth and evolution of our company, mostly from our clients, same clients who were actually trading and following along with us back in 2008, 2009. And one of the goals was to automate our strategies and expand them into other markets. And that's what we've done over the past 2 years. Today, we're a financial technology company that offers fully automated portfolios of strategies that trade alternative markets, primarily S&P futures and other equity index futures and bond futures markets. These strategies can be activated in your Interactive Brokers account with the help of a licensed professional, which I'll talk more about in just a moment. Rob, if you don't mind, go to the next slide, please. I'll let you drive. So in addition to the extensive experience that Rob brings to the table and myself as well, we actually have a third co-founder, David Skowron. He was a founding developer and architect of a company I started a long time ago. We took it public called SideQuest. He was a classmate from West Point, a good friend of mine there, and he's also a former commodity trading advisor, CTA, as you may know. Three of us have been in this industry a long time, and we've built InvestiQuant from the ground up in a way that we believe helps overcome the traditional challenges and limitations of other players in the industry. You probably have worked with or heard of system developers and seen many of the exciting returns that they show you using hypothetical charts. You may have worked with commodity trading advisors and even licensed and used those types of companies. But one of the things that we've noticed is that you don't see many of those guys stay around for very long, those organizations. They tend to be small and undercapitalized. So not have enough resources and sometimes not even have a real edge. So we have built our company with the vision of overcoming those challenges so that our strategies will persevere and will have the capacity to scale and take advantage of our edges that we've experienced and used for a long time. I should also mention that the director of Duke's University Center for Quantitative Modeling is a client of ours. He's also an investor, shareholder in our company, and he's on our board of directors. And perhaps the biggest advantage we have as a company, or differentiator, I guess, is when you take the collective experience of the three of us, and we have other traders on our team as well, we've been trading these very same edges, literally the same strategy in some cases, and technique for decades. And that's a significant advantage for us. So we are very different than some of the other players in this industry, and we're proud of that because we think that provides a unique edge, not for us so much, but also for you, an investor who may license some of our strategies. So, Rob, if you go to the next slide, we've got, just real quickly, before we get to Q&A, we've got several different portfolios of groups of strategies, if you will, that trade different markets. They're diversified within themselves. You can see a little bit of information there. And they range in their ability to handle smaller capital allocations than even shown on the slide here, or larger ones, like a family office may use. The ones I'm showing on this screen are the ones we've been trading the longest, has portfolios. They're intraday focused, meaning they carry no overnight exposure. Overnight exposure is not a bad thing. We actually have strategies, and it's actually one of Rob's expertises. But these particular portfolios are really efficient with the use of investors' capital because they are intraday only. They are designed to work in all market cycles, and we've personally had success trading these types of edges in all types of market environments. That really, as Rob pointed out, the greatest advantage of especially short-term strategies is when volatility is higher and you can trade in both directions. So during sideways, correcting, and volatile markets is really where we think we can shine the most, and that's how they've been designed. And with the markets at all-time highs, we think it's a great time, of course, to consider checking us out. We hope you will. Help you diversify your account, mitigate, as Rob calls it, and we call it crisis correlation risk. And right now, we've got about $15 million in capital trading all of our portfolios. We don't manage assets per se, but that's including of ourselves, our shareholders, many long-term clients, members of our board of directors. We're trading the exact portfolios in our very own accounts. So as we like to say, we like to eat our own cooking. And last slide, if you want to learn more, we'd love to hear from you. You can email me or Rob. You can also contact Scott Greenwell. Scott is not like a sales guy per se, which is probably what you're thinking. He's actually an executive vice president with the company. He's an early investor in our company. He was a client since 2010. He's actually on our board of directors, and he provides a really unique perspective about what we do and our portfolios, and he's trading them himself. And if you'd like to learn more about enabling your Interactive Brokers account, Julio Beaton, who's mentioned here or listed here, would love to talk to you. He's a senior vice president at Garwood, a U.S. registered broker-dealer. And he can talk to you about questions about how much capital you need to actually have in your account to trade our various futures-oriented portfolios. And I think the very last slide, Rob, is our webinar. So December 19th, if you're interested in learning more, I'll actually be conducting a webinar introducing and providing a real detailed overview of our portfolios, the two included and perhaps some other ones. We'll get into pricing and construction of them, even what creates their edges, some performance metrics as well. And we'd love to have you join us. That's Tuesday, December 19th at noon. It'll take about 30 minutes, and we'll have Q&A. Happy to answer any and all of your questions. But if you are ready to learn more right now, I know Scott Greenwell would love to hear from you, or myself, or Rob as well. And with that, I really appreciate all of your attention, and I think it's time for questions. If you got any questions, please feel free to post it using the question box that Cynthia mentioned at the beginning of our webinar. And again, we really appreciate the opportunity to be here with Interactive Brokers and Garwood Securities as well.
Scott, I see a question here.
Okay.
It's saying, can you tell me more about the relationship between Garwood, IB, and InvestiQuant, and would someone need to pay extra commissions to Garwood?
I'm going to let Julio, if you're there, I'm going to let you answer that. Julio Beaton is with us from Garwood Securities. Julio?
Hi, good afternoon. My name is Julio Beaton. I'm Senior Vice President at Garwood Securities. Garwood is a U.S. registered broker-dealer. We're an introducing broker to interactive brokers. We have extensive experience executing order flow for subscribers of technology providers such as InvestiQuant. And as such, we're the only introducing broker that can enable your interactive broker's account to be auto-traded using an automated portfolio from InvestiQuant. And the business model, the way it works, the process, there's basically three entities. There's InvestiQuant, obviously the developer of the systemic algorithmic strategies, which are designed to maximize return with risk management overlay. Second is Garwood, which will provide the clients high-touch phone and email support, new account onboarding, funding, and as Scott mentioned, any questions regarding margin requirements on the three various portfolios that IQ manages for intraday trading. And also, of course, Interactive Brokers, which provides clients with clearing, custody, and execution of the strategies via the client's Interactive Brokers account. And what we do is once the subscription is activated and all of the auto trade documentation is in place, there's an agreement regarding the auto trade. We turn on the InvestiQuant app to allow its signals to trade your account. And this app sits on a dedicated server at the Merc with connectivity to Interactive and the various futures exchanges where we execute. And in addition to ensuring that the trades are electronically executed properly, obviously we also ensure that they're closed out properly at the end of the day. And this entire process is fully automated. We don't normally need to intervene in the trade execution or management, but we can and will. Regarding cost, we offer a very transparent, low-cost commission structure. Clients are given the option of selecting fixed or variable tiered pricing structure. The difference is if you're trading pretty much less than 1,000 contracts a month, fixed is the way to go. If you're more than that, then the variable tiered is probably better for you because your rates will come down as the volume goes up. Fixed rate also does not charge an overnight handling fee, and variable does. And what we charge is we charge the interactive broker's rate of 85 cents a contract per side, plus the exchange regulatory clearing, and a small nominal fee of 15 cents a contract per side for the dedicated support and the infrastructure that we host at the Merc. So as an example, the S&P E-mini, using the S&P E-mini as an example, total execution cost would be $1 for commission plus $1.18, which is the CME exchange fees, plus a penny for regulatory fee, or $2.19 per contract per side, $4.38 round turn. The 10-year and the 30-year contract, and I mentioned these two because a lot of brokers charge you the same commission rate regardless, and this is part of the transparency. Actually, the exchange fees are less for 10-year and 30-year, so your commission should be less on the 10 and the 30. As an example, the 10-year, it would be $1 commission plus 65 cents exchange fees plus a penny regulatory. So it would be $1.66 per contract per side, or $3.32 round turn versus the $4.38 for the E-mini. And if you have any questions, please feel free to contact me, either email or phone. Email is probably a lot better. And just jot it down, and I'll revert with answers. And that's it.
Thanks, Julio.
Thank you, Julio.
Scott, seeing a few InvestiQuant related questions here. We can divide them up. One is John Harrington asking, do you sell data as well as portfolios?
Yeah, that's not really our business model, John. If you've got a specific question, you can email me or Rob, Scott, S-C-O-T-T, at InvestiQuant.com, or Rob, R-O-B, at InvestiQuant.com.
The next one looks like it's probably for me. It's asking, how exactly do you take advantage of the increased volatility during the adverse times? Ignati is asking that. Well, we can't tell you exactly how we're taking advantage of it, but we have strategies that are designed to work in different time frames. And so when you get increased volatility, a lot of times the shorter term time frames will be able to take advantage of that, simply because there's increased opportunity, like we were talking about, and you're also better able to control risk in shorter time frames. So as opposed to long-term strategy. You want to add something to that, Scott?
Yeah, I'm just going to remind. We're actually going to go into that on the webinar on the 19th. We're going to talk about what comprises our strategy. So we'll get a little bit more into the our opening strategies. We have some strategies that trade overnight, and even some swing as well. But we're using multiple systems, and we'll get into that in quite a bit on the webinar on the 19th.
Yeah, it's probably more appropriate for Jack. Has a question as well, which is, what has been your maximum drawdown with this intraday strategy since 2007?
Yeah, we'll cover performance information at the webinar in a little bit bigger detail. I can also share a little bit about my own personal performance with I've got a long-time automated gap system that's actually had the performance results verified and compiled by third parties, so happy to discuss that. Or Jack, you don't have to come wait till the webinar. If you're real interested, you can shoot me an email, Scott@InvestiQuant.com, or give Scott Greenwell a call or contact him. He can help you with broader performance information as well.
Scott, your mic broke up a little bit there for me as you were saying your email address. So it's Scott@InvestiQuant.com.
Correct.
And then there's a question from me just saying, Rob, do you think the market is about to suffer a big correction? And that's from Rick. Rick, it's about to suffer a big correction. It's not necessarily imminent. I'm sure a big correction is going to happen again at some point. We have been heading higher for a long time. I don't have a top calling strategy in place right now, and I think if anyone that had a top calling strategy probably would have called the top a few times between 2009 and now. But I think it's important to be ready when the market does turn. and it's important to be able to understand that the market evolves. The market has times of low volatility and high volatility, and you want to have strategies that are able to take advantage of multiple environments. Scott Raja is again, someone else is asking here about the performance returns, max drawdown of the strategies, and you can feel free to email Scott with any of that information. That's not something we can really get into the detail on here.
Yeah, and I don't want to sound too evasive, but this is educational. But we're proud of our results. I'll tell you that we do have live trading for the portfolios that we showed you. That's significant, and then our own proprietary trading as well. Happy to talk about that. And we're trading these same strategies and portfolios as we mentioned. I can tell you my own personal, and this is really driven by leverage, my own personal drawdown max that I ever want to endure is 20%. And again, you can adjust that, to your own, more or less leverage. But we're pretty conservative, and we think we've got pretty attractive, and that's why we've been able to attract so many clients that are licensing these strategies, and from family office size down to small individuals with smaller accounts. Rob, I see another question that was for me, if I may. Says and this is a little bit more direct. If your strategies are so good, why are you giving them away? Fair question. We've traded these things for a long time. We monitor our execution and our fills and the volume at those levels very closely. We've been doing this for years. This is what we do. And we've got excess capacity. So we've got clients trading these same strategies. There's a ton of volume and liquidity in the bond futures and the U.S. index futures, especially around the open and the close. And there's plenty of volume to handle quite a bit more capacity. We do have some ideas on that. We'd love to talk to you if you're interested. We do not have unlimited capacity. I will say that. We think we have tens of millions available for sure with our existing strategies, and actually a little bit more than that. And Rob, can you go back to the webinar page that shows the details to sign up for the webinar?
Right there. There's a link for people.
Thank you.
Craig Peters is asking me a question here saying, you classified intraday, short-term, swing as separate strategies from trend following and mean reversion. Would you say they're diversification of time frame rather than strategy? Could be. Yeah, I mean, it's shorter time frames is one way to gain that type of diversification. You could have a trend following strategy in looking at 1 minute bars, I suppose. But there's the point of that slide was basically that there's a lot of different ways to make money in this market, and that you don't want to just diversify across asset classes. That you want to be able to take advantage of opportunities as they arise, and the ability to identify those opportunities is important. And there's plenty of different ways that people make money in this market. There's, for every time someone's buying, someone else is selling, and vice versa. Being able to take advantage of different strategies, different environments is very important. So I would just provide some examples in that particular slide.
Rob, if I may add for Craig's sake, we will go into that a little bit more detail in the next webinar, but I can tell you as an intraday trader, I actually think of my strategies and classify them around either being mean reversion or trend following. But I tend to trade the opening gap, so I will often fade an opening gap which would mean to short an up gap or buy a down gap. That's a mean reversion strategy. I'll also do that on exhaustion types of gaps. If you get a really big overnight gap, opening gap, often after a prolonged trend to the upside or downside, we'll have an exhaustion move. That's also a mean reversion technique. But sometimes I'm actually following the gap. That means going or trading in the direction of the opening gap, expecting continuation that day for the rest of the day often. Those tend to be trend following, meaning they're following trading the opening gap in the direction of a broader or bigger term trend. So if you're in a raging bull market like we've been of late, and you have a prolonged sell-off, prolonged might be 3 days, 5 days longer, and you get a sizable up gap, often that's a good opportunity to get long and trade in the direction of the prevailing longer term trend. Again, I'm happy to get in greater detail at our next event or offline.
Yeah, that's a good point, Scott, and it's applicable to overnight and swing as well, where a strong move will mean one thing in a certain environment, and it will mean something completely different depending on where the market is relative to larger time frames or moving averages or a lot of different indicators that we use in our systems. So sometimes we might see a strong move up, and these swing strategies or overnight strategies might be looking to jump into that, and other times they might be looking to go the opposite way.
And just one more comment on performance, thinking about it, if I may, Rob. When I was talking about drawdowns and my own personal tolerances, if you will, I will note that our portfolios, and again, we'll be going into this more historically, nowhere near the kind of drawdown that I was talking about. Though I will say, because we try to keep those in single digits and have been successful doing so, but then in general, you want to take your worst drawdown in the past, whether it be real trading, hypothetical, or both, and assume that it could be bigger in the future.
All right, looks like I missed one question here asking, can we repost when the webinar and registration will be scheduled? Oh, I guess I was just looking to go back to this slide. I'm sorry.
Well, with that, it looks like we are going to conclude today's event. I want to thank the team at InvestiQuant for today's presentation, and I will be leaving this slide up in case you want to make note of the registration address, but we are going to conclude the event today. So with that, and by the way, I want to thank all of you for participating as well. We have been recording today's event, and I'll be as soon as I get that recording uploaded or compiled and uploaded to our server, we'll be sending out a direct link to the recorded playback, just in case you want to come back and review any of the concepts that were discussed here today. So with that, today's session is going to end. You can exit using the X in the upper right-hand corner of that control panel over on the right-hand side of your screen. Once again, thanks so much to Rob Hanna and Scott Andrews for today's presentation. Have a great rest of your day, everyone. Thanks so much for joining.